Welcome back. This is John Gatewood with Gatewood Wealth Solutions and our weekly market insights. And with me today is Aaron Tuttle, our Chief Investment Officer. Welcome back, Aaron.
John, I'm glad to be here.
This is quite a week in one day that we're having.
Yes.
Because of course, we have the Georgia Senate re-election yesterday.
The runoff, yes.
The runoff. We have the certification today. There's all kinds of things planned for that. And it looks like the Democrats have probably swept both seats in the Senate.
They pulled the hat trick, it looks like, where they won the presidency, the House, and the Senate. Now, there are many Republicans that disagree, and that's going to show up likely today in Congress in their joint session. So I don't know that much will come of it, but it's probably going to make a lot of noise.
It is going to make a lot of noise, but what'll be good for us is at least now we'll have a better direction in terms of what we're going to be able to forecast going forward. But we do have a lot of interesting things we want to report on today with regards to what this actually means in terms of political landscape going forward, the market, and so on. But why don't we get into the things that we're going to be covering in 2021? So this is our first broadcast this year. What are those things we want to talk about and track?
One, we want to track just our forecast that we put up there at the end of the year. So this will take place of that timeline. Timeline's not there. I know it was your favorite slide, John.
It was my favorite slide.
So this will take that out. In each section, we're hoping that the market insight, we can just consistently stay in that. So it's just, one, it's easier to produce each week, but also we think it'll be easier to follow on not only our forecasts, but a way to organize the process.
Right. So we're going to look at COVID-19 first.
Yes.
Where are we with the pandemic? We had some interesting stats that you were looking at.
Yeah, so one, there was a lot of data dropped in the new case counts and deaths from the previous year that's causing a little bit of a spike. Let's let that play through. Also, when we look at what states are the hot spots, you remember back whenever we were in June, July, and Florida and Texas were the hot spots. Well, that seasonality, which is what I think is happening, has returned back in California. Those may or may not remember, California is one of the first states to have positive cases show up. And we've argued that seasonality seems to be the best explanation. Now, California is by far the most strict on mandates and lockdowns, yet we're seeing a rise in cases in the state. It's one where I don't think they would be doing worse if they didn't have lockdowns, or better, I guess was what I mean. I don't think it has any impact whether we do these mandates or lockdowns because we're just seeing this flow through no matter what the states are doing. And what's likely to happen is we're going to get back in June and July. It'll be a muted return of the coronavirus, but it'll be a return, and if they continue to be more free, they'll probably get a lot of heckling because they're so open, they didn't do anything. Well, California is doing a lot of things and it's not mitigating it. So it seems that this virus is going to do its thing, whether we put things in place or not. Now, this is not a statement to say don't wear masks, don't wash hands, do all the precautions that we've always done. Everyone needs to assess their own risk. But from a...
this is more from if you look at a policy standpoint for whether businesses should be open,
right,
what type of restrictions that there should be, there's no consistent data that would say specifically that this policy actually impacts the spread of the virus by slowing it down or speeding it up.
Right.
And I think that's the important thing that's going to come out of this. In fact, I think that probably people and their personal adaptation has probably had a greater impact more than anything. That people are staying away from places, at least the ones that are more at risk. That doesn't mean that it's not going to spread.
Right.
But at the end of the day, the policy has really not made the difference.
Right. And if you go to Florida and they're open and you walk around and there's no mask mandate, majority of the people are wearing masks.
Now let's translate that from an economic perspective. So if that's the case, then what we want to be is to be as open as possible with people taking those personal responsibilities in hand in terms of the personal protection and so on.
Right, correct.
So, but then one of the questions I had asked you was, what would the total death difference be if there were no pandemic? Let's say, what would the expectation of deaths be? Because the majority of the people that have died from coronavirus, as we understand it, were older.
Yes.
And so the question is, how many of those would have passed away this year
Right.
if there were no coronavirus? Is there any statistical way to measure that?
Well, if you're on Twitter and there are people that tend to be on the right, will say that there's no change in deaths whatsoever in 2020, and there's a lot of statements on both sides that are untrue. And we decided to investigate this one based off of your request, and we have found that is an untrue statement. But it was a surprising. We were surprised whenever we started to look in this. So if we look on the left, we see 2014 to 2019. And we can see that there is a cyclical component to the amount of deaths. So we're looking at weekly total deaths here. And each January, there is a spike. Sometimes it's a bigger spike, so it's a worse flu season than others. You can see 2018 was pretty high. And what we noticed is, one, that the dips kept getting higher each year. And then we ran a regression line to find out what was that slope. And we can see that 2014 to 2019, a general trend of deaths increasing by about 1.8% each year was found. And it's a steady thing. And that makes sense. The baby boomers were a big baby boom in decades. So it's not like every year the same amount of people are born. So there's
So you would expect a higher number of people dying just because
you expect some dips.
There's this large demographic pool that's passing through the older age.
Right. So we have populations. So the population in 2014 is actually younger than the population in 2019. So you would see an increase in death, and that regression line is there. And like I said, it was about 1.7, 1.8% increase year over year. When we get into 2014 to 2020. So same years, but now we're adding 2020. That increase jumps to 3.3%.
So there is a difference.
There is a difference between the years.
So you would interpret from that, of course, that the pandemic actually did have an impact, I would assume.
It certainly has had an impact. Now the question is, what is that impact?
Yes.
And if we look at that 2018, many people probably don't know. I didn't until we started to search in 2018 for the influenza. There was a pandemic in 2018. This was, and it's a small data set. This is a 3 standard deviation. So it was an event that happened that was out of the norm.
So when you say 3 standard deviation, what does that mean to our listeners?
It's like a 1 in 100 type of event.
Or it's 3 times whatever the norm would be. It would be 3 times more what you would expect that to be.
And whenever we look at 2020, it's a 4 standard deviation. 4.8, almost a 5 standard deviation. So it is a jump, but we're talking about both low probability events in this. And if so whenever we start to look at this and answer your question of how many additional deaths, well, we have to consider that 2018s do happen, that the population is getting older. So we were able to calculate, we estimate 227,000 additional deaths in 2020. Now there's another interesting component. It doesn't really make a big impact, but 2020 is a leap year. There's actually an extra day. So you'd actually need to subtract 8,000 to account for that extra day. But that shows, well, what that isn't is the 350 to 370,000 deaths. I can't remember if it was 350 or 370 that we're at right now.
For the coronavirus.
So there is some that you would have expected to die from influenza that you have to back out. And this is going back to 2018. And in comparison, so to say 227,000 is not the 2.2 million that we were warned about early on in 2020. It's much lower. In comparison, though, there was 13,000 additional deaths from the normal flu season in 2018. So we do see an increase there. Also, notice in 2020, we have that big spike, but there's 2 more humps. We don't have the cyclical reversion below that regression line. It stays above. So there are additional deaths there it's kind of like an echo boom that happened initially in the colder states, the states that we'll probably see another bump here in the next few months. as we get into the spring.
Yeah, so
Then we had the
that's
Sun Belt, and then we had the second wave. So
one of the things we talked about is there's probably going to be a third wave.
right,
Now,
but we
the
should expect
impact of
those
that is-
waves to slowly decrease over
Yes,
time.
and especially now that the vaccine's out and fewer people will be susceptible to it. So hopefully that'll start to mitigate that. But it would not be unreasonable to assume that we could have a third surge in the next few months.
A third surge, but each time they should get smaller and smaller. Now, another way that we wanted to look at this is we take that regression line, just that's what we would expect because the aging population don't have any seasonality, and just look at how often they go above. And then what we're trying to understand, because we do have these multiple waves, is how many deaths are during the surge? And if we look here in 2018, we have about 89,000 deaths in that surge, and then we compare it to 2020. We hope it's dropping. The two data points that are the last 2 weeks is CDC is a little bit slow on gathering that data. I think they'll lift up. So we haven't dipped below. So that's 169,000. So a little bit close to double what we experienced in 2018. And it's not yet over, but we've probably seen most of the deaths already. So yes, COVID has certainly increased the total deaths, and we've had a couple of waves as well. However, I don't think the magnitude of death increases really resembles the magnitude of changes that we felt in society. They're different orders of magnitude.
Yes.
And some would say, well, the reason the deaths are so low is because of those changes. Well, one, scientifically, you can't prove things through positives, right? You may do a ritual every time you go up to bat to hit a ball, and you hit home runs when you do it. It's probably not that ritual. It's probably just coincidental that's happening. And we know that's probably the case because any negative actually disproves things. So
By
in
the way,
science,
I didn't realize that you were watching me in the batting cage because I do get a lot of home runs, But
so
anyway, so
I know I want to go on a tangent on why that actually does
Yeah,
matter,
but-
but I'm not going to go there. The behavioral component of
Right,
our
it's a behavioral component. But I think the good news is that we definitely see that this is going to eventually mitigate itself, and the economy is going to continue to move on.
right.
I mean, really, unless some other strain might come out that we're totally unprepared for. But
And there will be mutations.
Yes, there definitely will be. But
And
don't you
most
think
of the
that we're-
mutations don't actually get worse. There are examples. 1918 Spanish flu was an example of a strain getting worse.
Yes.
But one of the reasons vaccines for the flu tend to be ineffective is because there's just mutations. I would expect to see similar things here, and let's just hope that it isn't that there isn't an increase. But on that negative, we can look at California and see that all these doesn't seem to really be making an impact.
Right.
So just continue to take responsibility for yourself on making sure your hands are washed, trying to isolate, and if you're sick, stay home if you're going back to work.
I'd say that's probably the biggest change for just me, because I know that if I was feeling sick, I would go to work anyway. But now, I think it's going to be totally different for everybody.
Another thing that we talked about whenever we looked at this data was, well, what about the lockdowns having an impact on car accidents and others? And there certainly should be less accidents, but we have seen an increase in suicides and overdoses this year. Now, how those offset, the data isn't in yet, but so we don't think that is as persuasive of saying that, well, we don't really know. We don't really know, but to really derail this narrative.
Well, let's move into politics.
Oh, do we have to?
That's so much more fun.
No.
How is that going to impact?
Speaking of
our world
viruses.
going forward?
So last night we watched an election, and Warnock has already been confirmed as a winner of his election. The other, Ossoff and Perdue, is still too close to call. It does look like the Democrats will get that seat as well. What is very interesting is Warnock is, if we were to look at this left-right paradigm, he's very much on the left. And Georgia is not a state that you would consider very much on the left. So how is he able to really win this election? One, we got to go and look at, because we just had the November 3rd election, and then we have this election. It's supposed to be the same group of people.
So how did that compare? So in other words, you had all these voters come out November 3rd, and now you had them come out yesterday.
Right.
what are those differences?
So
in
when we're
turnout?
comparing it, we can see that we had 4.4 million come out yesterday compared to 4.95, so about 500,000 people less. Huge turnout for a runoff election, but
Right,
the
but
stakes
that's
were
still a
very
big
high,
difference.
right? And if we look at Purdue's number in November, 2.46 million, which was higher than Ossoff's at 1.37. Ossoff does lose about 170,000 votes, but Purdue loses far more. And I don't think the Libertarians showed up for the election whatsoever. So what's going on there? And what is happening is, if we look at the votes that came in and how and what the total is, and then look at what happened relative to November, there's a shift to Democrats, especially in the suburban counties. So what that means is the Trump voters did not show up for this runoff, especially in the suburban counties, those rural areas. And if we look at the where the votes came, you can see there's definitely an urban versus rural mix-up. So the party paradigms are changing from left to right to more populism.
So explain what that means.
So populism, I would think a lot of people, because we're still programmed to think of the world and politics as left and right, would see President Trump and Senator Sanders as polar opposites. But they're actually both populist candidates. Both of them were advocating for those $2,000 checks, right? So it's about a difference between not what is my view on taxes, but what is my status within society. Am I an elite? Am I in the East Coast and West Coast technocratic bubbles? Am I in Washington, D.C., or am I in Main Street? And so this is not a free market component, because both of these individuals are arguing for checks to be sent out to individuals for protectionism. So there's a change in the way that we view politics in the electorate.
So they both want the same thing, but they have totally different economic
approaches to get there.
Yeah.
But they're using very similar rhetoric, to the point that last night, or I guess it was not last night. Last night the video surfaced, but Mitt Romney was traveling from Utah to the Senate today. And also, January 6th has a lot of Trump protesters showing up in D.C. While he was at the airport, they challenged him. They came up and they heckled him. They heckled him in the airplane. The ride was them calling him a traitor the whole time. The Mitt Romneys and the Mitch McConnells, the more middle of the road Republicans, are in trouble within the Democratic Party, and they know that because they're now looking.
The Republican Party.
In the Republican Party, they know that because they now look and see that Trump not being on the ticket caused them to lose an election that, in their mind, they should have won. A very left candidate winning in a right state.
So I guess the point would be that that the voters who didn't show up didn't see Purdue perhaps as a populist candidate, but as a Republican. Would
Right.
that be what you're saying here?
As a GOP person, he doesn't inspire enough people to come out and vote for him, because that suburban Trump voter is not going to show up. And we're already seeing this in the state capital, Pennsylvania. They had a senator, the state senator, that was supposed to be brought into this. I can't remember the name that they used for it, but basically you got to be sworn in. They wouldn't do it, and they actually pulled the pro temp speaker out, who was supposed to run this delegation. So there's this huge backlash that's happening underneath the Republican Party, and the Republican Party is probably going to be a populist party going forward. Mitch McConnell is going to lose out, and we can see that.
What about the Democratic Party? Because
they
have the left, the far left, right? That is socialism.
Yes.
And then you have those that are what may have been considered the blue dog Democrats, but even that's kind of melting away a little bit.
Yeah, I think that Senator Sanders and Trump are hitting that same demographic. That blue dog Democrat is what they're trying to bring out. After the House lost as many elections, they lost every contested election to Republicans for this recent election. They had their own infighting. I'm surprised that Speaker Pelosi is still Speaker Pelosi. It was close for her. So there's infighting in the Democratic Party, same reasons. There is a change in the way people view their politics. So I don't know what the outcome is going to be for each party. Who's going to ultimately catch the populist vote? Whoever does it is going to be the party in power. But it doesn't look good for free market capitalism if you support Republicans, because look at Senator Hawley. He announced that he was going to be one of the senators, the first senator to do so, to contest the election today. And Walmart had an employee that's part of the marketing department that tweeted out a statement that would have been a personal statement, not necessarily a statement, but he or she didn't log out of the right account. And then Hawley responded back with accusing Walmart of using slave labor, of paying individuals low wages, and importing goods. This is a Republican U.S. senator from the state of Missouri using what just a few years ago we would have said is Elizabeth Warren type language. So that's the change that we're dealing with, that we're seeing in politics. And then we get to today. So Mitch McConnell was one of the impediments to this electoral vote college. He probably is not going to have a lot of sway today, and Senator Hawley will have a lot more sway. Now, I don't think anything's going to come of it. It's going to be mainly noise. But my guess is they'll do something like, hey, we got to create a commission. Let's wait 10 days. Let's try to extend the inauguration. Whether any of it actually materializes, I think it's unlikely. The Democrats control the House. The Senate, they would need 51 votes. They're not going to get it. So I don't think there's much to do other than make a lot of noise. And that's the point of the protest that's going to happen, where it has a lot of these people coming into D.C.
It's more noise than what's actually going to change that's going to happen as a result.
Yes.
So thinking about this going forward, so we're going to have the Democratic House, Senate, and White House.
Yes.
We've been talking about what policies and changes that we may see as a result of, a mixed House versus a sweep. Where do we see things now?
So we don't think that there's going to be big tax changes.
I think that was one of the big issues that we heard from clients, is that
Yes.
they were wondering about the taxes because of the potential for having higher taxes.
And here's the reason we think we don't think it's as likely as, let's say, if they would have had 56 senators. When the margins are not there. You usually don't keep, whenever you have control of all branches of the government, you usually don't keep them the next election. And nobody wants to be the person booted out. So they're less likely to go with a big tax reform. Also, why do you need to do it? We just printed trillions of dollars in 2020 to fund spending, and we didn't need to raise taxes.
I wonder if they can print dollars just to pay themselves back. That might be.
Don't give them ideas, Jeff. So we think what's likely, there will be red meat proposals. The gender pronoun component that happened in the House is one of those red meat things. Probably not a big impact in the market, more to appease certain people, and really more noise than anything else. What we think is likely to be the low-hanging fruit and something that they can get behind, and increase their likeliness of getting elected on the next term, it would be a large infrastructure spend.
So that's going to certainly be a market mover.
Right. So materials, industrials, as well as inflation hedge, gold, and others. Bitcoin has been acting as one. There still is that very low probability event that somehow Trump gets a second term. If that's the case, the shenanigans of politics will continue on, because now the House and Senate are controlled by the Democrats, and impeachment proceedings will probably
somehow, though, I think that if things just go as they're probably going to go, Biden will be elected president. I think we're still going to have shenanigans.
As we're talking about this,
isn't that the way it's
as we're talking about this, I'm realizing
DC?
if I'm Pence, I want that to happen, because then I'm the president.
Right.
So maybe that increases the odds. We'll see today. So then we get into the domestic economy, and we spend a lot of time. Hopefully, this is the last time that we spend a lot of time on politics. That the election is done and passed and over. But money supply is really a major policy change that happened in 2020. It's been continuing to grow to the point that we're a little bit more in the bullish camp going into the market. I know it's at all-time highs. Another slide will help that. But look at this. It's the M1 down below, the graph below.
So explain the difference between the M1 and the M2 and the money supply.
M2 is trying to measure the entire money supply. So cash balance in your life insurance, a lot of people view that as part of their cash. It's technically in the market, but it's the perception. You also have loans and other things. But then that's all pyramided off currency created by the Federal Reserve. So M1 is just what did the Federal Reserve create in the system. And they've been creating Federal Reserve notes since 1913. And if we were to look at 2020, and you can see that hockey stick, this is what you would anticipate seeing for the deaths for the coronavirus in 2020 relative to other years, is this hockey stick movement. Certainly pronounced, but not a hockey stick movement. This hockey stick, it's so high that 40% of all dollars created by the Federal Reserve was in 2020.
So I want to emphasize this point because for our listeners, this has been an historic year because, as you say, the Fed has actually created 40% of all money ever created.
All the foundational money.
Of the foundational money. So how is that going to change economics, economic activity, and the market movements going forward? It's almost mind-blowing when you think about it, because we're really almost in an experimental period of our monetary system.
Yes, we're able to get away with it right now because we're in such a dynamic economy where real production is increasing at a dramatic pace because of the information age.
Yes.
So that's the reason they're able to get away with it, is because there's so much technological deflation that it's masking this. It's still a problem. It'll eventually make it into the tangible economy, but it doesn't mean that the way that we think of inflation, just the rising prices relative to what they were yesterday, is necessarily the case, because look at the slope from 2008 on. I mean, that was a dramatic increase in the amount of money being created by the Federal Reserve, and now we're on this new exponential curve. So,
well, just to reiterate what you're saying is that if we look to sort of the pre-technology age, if we experienced an increase in the money supply like this, we would have seen super high inflation.
yes.
The reason why we're not seeing it is because we have these massive deflationary forces. Number one is technology. That's been the one thing that has kept us from actually the inflation aspect of it creeping into society. But that won't be like that forever.
No, at some point you'll hit the diminishing returns of the new technology will start to slow, and you can't. The money supply has to actually continue to grow at a rapid pace. If it just slows, that can cause the correction. That's what we saw in 2008. It's just a slowing of the money supply. So we will either get that, or if you continue to print, you get a crack up boom where people just lose faith in the currency because prices are it's just, why not? What does it mean when you can just continue to print it with no repercussions?
Well, I think this is one of the reasons why it's even more important as part of our investment strategy to monitor the money supply. So we have studied that through our investment committee. So maybe you can talk a little bit about the relationship of the money supply and the market.
We actually have a slide, so let's not steal my thunder. I'm gonna get to that.
You anticipated what I was going to ask.
Well, you did. You asked about it afterwards last week. So let's move on, because one of the things, the U.S. has problems. Everyone has problems, and everyone keeps talking about China being the new superpower. They certainly are going to grow in power, but the U.S. Is a little bit more innovative. We probably have become a little bit more control focused than innovative focused over this last year, but it's nowhere near to this level. So Jack Ma is the wealthiest person in China, and he had made statements and is now missing. And many people now say he's just remaining low. And his last tweet was back in October 10th. So this is the most wealthy person in China having to hide out from the government, running the most powerful or the most valuable company in the system. The control in China is going to stymie a lot of the innovation. So we have internal problems domestically. They have much greater problems.
Well, we read yesterday about how 20 pro-democracy people were arrested in Hong Kong.
Right.
And you would think that Hong Kong is more pro-West, but now they're cracking down for more control.
because they are more pro-West, because they tend to have a more laissez-faire approach. Now, what was it that Jack Ma was protesting against or made these statements that caused him to have to go in hiding? Lending facilities. So back to the monetary issues. The economies work the same, right? It's a science, social science, but it's still a science. So the economic rules apply to China just as much as they do in the U.S. And they're having problems with the amount of debt that they have created in their system, and they're having to try to put in capital controls, and that's what he was actually. So we see problems in China. We don't see it as the U.S. is doing everything wrong, and we're a basket case. We kind of are a basket case, but their basket is just as bad, if not worse. So I wouldn't expect to see major political changes. We could be wrong, but they have problems.
So we're still favoring the U.S. domestic.
Yes.
Still favoring technology.
Yes.
What
Inflation
about-
risks are still high. Residential, that flight from urban to suburban areas is still in place. So no changes in our themes. The market continues to climb this wall of worry, make new highs. We did get a sell-off at the beginning of the year and a rebound. With the amount of money supply that's gone, we expect that to continue up. And here's that slide on the monetary side. So this is going back to 2007. The red is the S&P 500. And the blue is the money supply. And you can see that they've been growing pretty much at the same rate. Now, the S&P is a lot more volatile. If you look down below, you can see the growth or the rate of change on the money supply. I don't want to share our secret on how we smooth this out and kind of look at this so it'll be a little bit more visually obvious. But you can see down here in 2008, there's a lot of spikes and it's hitting down to zero. And that was an indicator that the money supply, it actually went negative, and that was the correction. And then out of 2008, we see that the money supply takes off. Its growth rate is very high. It starts to slow down. You see a similar slowdown in the S&P 500. Then we spike up in 2011, 2012, really expand and turn on the spigots, have a major run up. We don't see a slowdown in the money supply for this last one, but it was an exogenous event. It was the government coming in and locking us down because of the coronavirus, and then just a moonshot. I mean, look at that change relative to 2011, 2008, which whenever that was happening, everyone was saying helicopter money, and this is just orders of magnitude much, much higher on this.
Now, would we expect there to be downward pressure on the S&P and the other indices because of the Democratic sweep?
Not with this amount of money supply creation. As bad as economic policies as governments can come up with, and they can tax and they can do all these things to have an impact, if central banks are printing money, the market will move up. And we saw this in Venezuela. We're nothing like that situation, right? But that's how bad policies can be. But if you look at that stock market within the price denominated in their local currency, it's astronomical returns. So the market's going to move to money supply. However, you're going to see an impact of inflation. We are seeing a drop and a decline in the dollar. We're getting very close to our 2017 lows. If we break that, we go down to the previous lows in 2014, where it's under $80 for the dollar index weighted to other baskets of currencies.
So how would that play into, let's say, U.S. versus international market weightings?
That gets us to our next slide here. Because we are an importing nation, we import a lot of goods, and we buy them with U.S. dollars, so the exchange rate is important. So if we go all the way out to 2020, I probably should have zoomed in, but to kind of give you an impact, the dollar has been declining, and what we can buy, those broad goods and services internationally, has also been dropping with the dollar. And that's eventually going to make its way into the CPI, but I'm sure people are already starting to notice that things are more expensive with the things that they're buying because of just the dollar exchange. And we think that the dollar will continue to decline. Eventually it makes U.S. exports cheaper, and we begin to export. So we can see economic positives from that, but it's at the expense of your standard of living costing more.
How do you create the balance in between international and domestic? You know, Because you can see a benefit on both sides.
Well, it's always in balance, and that's what a lot of people don't understand is when you run a trade deficit, you will have a capital surplus. We have been able to borrow at very low rates or have that money reinvested in real estate and other things. So the trade is always going to be balanced. So if you have a trade surplus, you're going to have a capital flow out. So if you have a trade deficit, you have a capital flow in. It's probably going to mute. If we were on a gold standard, you would have constant cycles. Because you can just expand the money supply here in the U.S., you can run deficits for a very, very long time. But the capital account has to balance out.
Yeah.
So it's always neutral. Relative strength, if we look, emerging markets is moving up. We're a little concerned about China, but other areas, especially commodity heavy, we're kind of, commodity is not rising here on relative strength yet, but we think that it is a trade that we anticipate clients will see in their portfolio at some point in the year. Timing's not there yet, but small cap, mid cap are still the winners at the moment.
So bonds, yields, and so on have been things that we've been concerned about. So
Yes.
How is that looking?
So this is a chart when you take the 10-year rate on the Treasury and you subtract the 2-year, you see the spread between the two. And if that spread is widening, which it is, it makes it more advantageous for the banks to loan money. And that's the M2 component. That's how the money supply can be expanded by the banks.
Now they have
an incentive
margin.
to, right. Every loan that they make, they're making a spread on, and they get the money back, and they just do it again and again and again and again, and levers that up. So that is an incentive for banks to loan. It also is an indicator that inflation is possibly getting priced in because 10-year rates are higher than 2-year rates. Nothing's really changed, so there's some inflation premium that's getting added in there. And it's a combination because it's a system that is symbiotic. That relationship is feeding on each other. So we are seeing that increase. Banks could loan money. Even if the Fed was to slow down its buying of assets and Congress slows down their spending, never happened. But if they were to do that, you could still see the money supply growing if people are loaning money out. And as this increases, that is likely to increase in likelihood.
So what do you think the greatest risk would be that we may not be thinking about?
That we may not be thinking about, other than Transformers coming to the planet?
Right. Now, I understand that's certainly a possibility.
There have been a lot of new UFO sightings.
I know there
late.
was one out in Las Vegas, I think, that was broadcast last, or off of Hawaii. No,
Hawaii,
Hawaii.
yeah, the blue
Right.
thing.
Right.
Well, I mean, you're asking about what is a black swan event, which is unknowable until it happens, then obvious afterwards. So you're asking me to answer a question that
there's no answer
that there
to
really isn't
until
an
it
answer
actually
to.
occurs.
Absolutely.
Yeah.
I would say the big thing is just monetary policy. That because we've been able to get away with it, because we can print money and it doesn't seem to have any adverse effects, I think that's changing our behavior. And at some point, we're not going to be gaining so much from what is happening in the economy, and that slowdown is going to have an impact. Now, is that 10 years from now, 20 years from now, 2 days from now? Impossible to tell. We should see it in the money supply numbers, so we'll continue to watch. And then there's always the market volatility, right?
So there's a couple of things that I noticed in the Bank of America 2021 forecasts. Okay, and one was that they believed that corporate profits were going to be very strong. And what would that mean to the market? What's our view on that?
Well, one, we're coming out of a very sharp sell-off with revenues down. But if you look at top-line revenue versus bottom-line revenue held up a lot better than top-line revenue. And that means that there was a lot of excess costs that companies were able to get. So that means they're leaner and meaner going forward. Now, that's not the case for everyone. If you're in that value sector, those low PEs, or a service sector, you certainly have not benefited from this, and there's a lot of struggling companies. But corrections and bear markets and recessions have a way of really clearing the debris. and we've gone through that. So I think we would align with that the corporate profits are going to increase. What may be a problem is that we have these strong companies. It's really that K recovery where there's a group in the economy that have done really, really well, and then there's a group of the economy that has not done well. And that is going to show up as political unrest, and we've been seeing that on both sides, right? You have the Proud Boys, you have Antifa, you have both extremes, and they may even somehow figure out how to come together and be a single force because they have more in common on something, the enemy of my enemy is my friend type of thing. So it's not that the economy's hunky-dory and everything's great. You have a lot of people that have missed out on this economy. So that is a factor.
So another comment that they had, that they believe that this is going to be a good year for active investment management. And we know, people have always had the discussions, active versus passive. Well, we believe that we can, through active management, create some excess return. And we've been able to do that historically. But they believe that this is going to be an even better year for that. What is our opinion on that?
I don't think there's really any person or entity or system that actually does passive investing. Everyone is looking at some type of factor. So if you buy the S&P 500, it's quality companies. Why those 500 companies? If you buy the Qs, you're taking an active position in technology. What's happened with these ETFs and these passive vehicles is basically a low-cost screener. You're not having to pay somebody to do the due diligence on cash flow and other things, and we really have computer systems that do a pretty decent job at that. That being said, there are going to be winners and losers, and there's a paradox with that efficient market hypothesis is that you can't beat the market because there's too many people watching it. So then everyone goes to these low-cost platforms. Then you don't have as many people watching the market because you don't hire as many analysts to run these things. So then there's inefficiencies in the market. So then it pays to be active management. At some point, this does go back the other way. But I think too many people argue over passive versus active. If you're buying equity for the long term, whether you're active or passive, you're going to be able to achieve your goals. You're going to get market returns, and sometimes you get a little extra for good active management. Sometimes there's a little extra drag because their active management has costs that are higher than the benefit of doing that due diligence.
Well, let's relate this to the K recovery. So if you have some companies that are doing very well and others that are declining, and if you're in a passive strategy, you're buying the market, so you're actually getting the good with the bad, right? So
and that's why you see 50% return in our portfolio and 12% in the benchmark. 12% is a solid return.
Absolutely.
50% is because we bought most of those companies that were going up. We were heavy technology, so technology lifted the S&P 500, but it's mainly the technology side. We looked at that slide a couple of weeks ago where most of the return was in 3 sectors, and then if you looked at communication services and what was the other one? It was Amazon and Google, basically in those 2 sectors. So it was all what we would have called 5 years ago technology stocks. So buying the winners and avoiding the losers is going to do well, especially whenever years like last year, whenever the disparity is so high.
Right. Well, I think we're out of time again, but that was a great discussion, and we're going to have lots of cool stuff we're going to be covering this year. Hopefully, it'll be a better year than last year from a societal standpoint. The pandemic will be slowing down. Hopefully, we'll return to what we call normal life, whatever that normal life is.
What is normal?
Yeah, I think that things are probably going to be much different going forward than what we've seen in the past. But but we'll make it through. We're human beings, and we adapt well.
Yes.
So I want to thank our listeners again for joining us today. We would, as always, love to have you subscribe if you haven't already. So if you look to the bottom right of your screen, you'll see that there's a button that you can push to subscribe to our video broadcast so that you will always be aware that we're here. And we also welcome any feedback because we're always looking to improve our broadcast. And if you have any questions at all, be sure to reach out to one of our lead advisors or anyone on our team, whether you're a client or you're just somebody interested in learning more about what we do or how we can help. Call the number on our screen, which is 314-924-5100. So once again, here we are. We're just trying to sift through the noise so we can find the signal and get you closer to the truth so you can be better informed on your portfolios. Thanks again and have a great day.